topic for discussion today will be concerning life insurance. And we'll be discussing the difference between whole life and term. Now I want you to take into consideration this hypothetical situation. Let's say you and your family are currently banking with a community bank, but you're moving to a different city, a different state, and you've now decided to bank with a commercial bank. Well, down the street from your house is Bank A and Bank B, right across from each other. So you first go to Bank A, and they tell you that there is a monthly $20 enrollment fee for the first year. So the first year you bank with them, in order to have an account, you have to pay a $20 monthly fee. Now, you go over to Bank B, and they tell you that there's no enrollment fee whatsoever. You can bank there for free. So you go back to Bank A, and you ask them, well, what if I wanted to earn some money on the money that I'm saving there? And they tell you that we can guarantee you at least 1 to 4% on your money. So you go over to Bank B, and they tell you that you need to invest elsewhere, somewhere outside of the bank. And they give you somebody else to work with that can guarantee you 8 to 12% on your money. So you go back to Bank A, and you're confused because most of your family members and friends, they bank with Bank A. It's the most popular bank. Everybody's banking with Bank A. And you ask them, well, what if I want to take my money out of my savings? And they tell you there is a withdrawal fee, which means the money that you borrow from yourself will be taxed. And you go to Bank B, and you ask them, what about my savings? And they tell you that it's your money, take it out whenever you want to, whenever you need to. There is no withdrawal fee from your account. Now, you go back to Bank A because it's not looking too good, and you tell them, well, what happens to my money when I die? And they tell you that the bank keeps your money. And you go back to Bank B, and they tell you that your family will have your money after you pass away. Now, it doesn't take a rocket scientist to know that anyone would bank with Bank B. But unfortunately, 80 to 90% of people are banking with Bank A inside of their life insurance policy, which is whole life. 80 to 90% of people are banking with Bank A inside of their whole life policy. Now, when it comes to whole life, first of all, just like the name says, you pay for it until the day you die, for your whole life. And also, there is an investment attached to that policy as well. And you will earn no more than 4% on your money. But keep in mind that inflation is also 4%, so you actually do not gain in the end. Also, if you want to borrow the money that you've already invested, there'll be a penalty tax for it. And when you die, the insurance company will keep your money that you saved and pay off the death claim to your beneficiary. But term insurance, you only pay for coverage over a period of time, preferably 30 to 35 years. And unlike whole life, there is no investment attached to it. It's pure insurance costing 3 times less than whole life insurance. Now please, people, don't take my word for it. If you like, you can go out and purchase this book, Personal Finances for Dummies. Chapter 15 and Chapter 16 covers life insurance. In Chapter 15, page 301, it simply says this: insurance is probably the most misunderstood and least monitored area of personal finance. Studies show that more than 90% of Americans purchase and carry the wrong types and amounts of insurance coverage. In Chapter 16, page 322, it compares term life insurance to whole life insurance, or some people may call it cash value insurance. And it simply says, I am going to tell you how you can save hours of time and thousands of dollars. Ready? Buy term life insurance. Also in chapter 16, page 326, it goes on by saying, purchase low-cost term insurance and do your investing separately. Life insurance is rarely a permanent need. Over time, you can reduce the amount of term insurance you carry as your financial obligations lessen and you accumulate more assets. So in closing, I have these two illustrations behind me in order to drive my point on home. Now, if you have a whole life policy, most likely you'll pay for insurance from the time you find a job, get married, have children, all the way up until the time you die, paying for coverage your whole life. But we have a thing called decreasing responsibility. Now, in order to understand why you need a term policy, you first have to realize why you need insurance in the first place. And that's because if you have a young family, you have a lot of responsibility and no money. No money saved. So that's why you need that policy. But as time goes on and you invest your money correctly, you now have money and less responsibility. The children are out of the house, the home is paid for, so at this time, you don't need the policy anymore. It usually takes a person 30, 35 years in order to get this accomplished. So as you can see, term insurance is always the way to go.